trading with expertise in technical analysis using options to hedge and speculate and portfolio asset management. He uses technical analysis, market internals, sentiment gauges, and volatility to trade stocks and options using Master Trader's techno-fundamental approach. He's former Master Trader with Greg Capra, an icon technical analysis to educate self-directed traders in trading and investing. Here to present selling iron condors to profit in range-bound markets is Mr. Dan Gibby of the Master Trader. Welcome back to Traders Corner, Dan.
Awesome. Thanks so much for those kind words. We have a fantastic subject here today, not only in today's market, but what's wonderful about selling credit spreads and in particular condors today, it's a very specific and unique setup where we can profit in any market, up, down, or sideways. This is the Master Trader technical approach to trading anything that moves on any time frame. We trade stocks, ETFs, cryptocurrencies, futures. It doesn't matter. We start with price is king. No setup, no action, as my students know. And then we take the messages of the pattern and the candlesticks of what's preceded it, and we put it in the overall trend. Multiple time frame analysis. Is it on support or resistance? Volume is secondary to us. What are the broader markets doing? Is it showing relative strength, relative weakness? Market internals, as you mentioned the term, techno-fundamental approach, then we look at market internals to give us high probability warning signs of turns in the market. Once you're in a trade, you simply, or once you have a high probability setup, you simply calculate position size for your trading plan, enter and manage in between. That's all trading is. I often make silly analogies to, it could be a Nordstrom, a clothing manager of the men's department. He is just buying and selling inventory with the intent to make money on the cost differential. If something's not working, you discount it, mark it down, and get it out of your inventory. Now, we trade options both to, is what I call directional, which is we have a high probability setup where we want to profit on our directional bias. And that's not what I'm going to focus on today. Today, I'm going to focus on selling options, which is what we call an income strategy. And we're technically based, so everything starts with a chart. There are some option traders who just like to trade by the Greeks, if you will, and the Greeks are what makes option prices move around. We don't. We think that's an ostrich approach, not to have a bias on something that you're trading and just looking at mathematics, where the math is directional neutral. The option prices have no idea what the underlying looks like. When we're selling options, our goal here is to earn the income from the premium that we are selling. We love selling 10 days or less options because of, I'm not going to get into the Greeks, because we like to keep things simple. But time decay is, if you want to look it up, is theta. When people buy options, the underlying has to move or else they are going to lose. Why do I have a picture of some melting ice cubes here? Because that is our income when we're selling options. The time decay of those options that is hurting the option buyer is our profit. Well, it's part of the profit. The other profit we get is called volatility contraction, when we sell high implied volatility options and then the fear subsides, we make money on that. And obviously, as the stock's moving in the intended direction, we make money on that also. So the beautiful thing of selling credit spreads, and today Condor you're going to see, is just two credit spreads. It's that simple. We're getting paid to predict where stock is not going. I mean, imagine walking into to Wynn Hotel in Las Vegas and say, hey, can you tell me where the booth is, where I can make money, just saying where the stock's not going to go? It's like, sir, you are in the wrong building. So we start, this is our edge. We have over 85% success rate. We manage them in between. You don't have to time for your entries with perfection. You're just calling tops and bottoms. Once we're in it, you'll see we manage it. There's different ways to management. You can do nothing. Use stop losses, which we do. You can adjust, you can hedge, you can roll. Obviously in 45 minutes, I can't get into this, but I promise you I'm going to do the best that I can. My partner Greg and I mean, he really is the pioneer of technical analysis, and I've learned so much with him, and I overlay my option skills and we combine them to have a very unique and successful approach to our method. All right, so I'm talking to little Johnny here, 8-year-old Johnny. Johnny, stocks can only do one of three things. They go up, higher high, higher lows, lower highs, lower lows, relatively equal highs or lows. Okay, Johnny, are we on board? Yes, sir. I mean, of course, we'll get into pivots and teach little Johnny in baby steps. So when we sell bull put credit spreads, we're profiting if the stock goes up, sideways, and it can even go down all the way to my break even, and I make money. Bear call, the opposite. We're selling out of the money call spreads, and I don't think it's going to go up there, and I keep the money. This past week, we've been very profitable selling call spreads. And so the premium that you take, I call it, you get a built-in cushion to be wrong. If you trade directionally, the underlying alone, stocks, option, cryptocurrency, futures, etc., you are only going to make money long if it goes up, and you're only going to make money down if you're short. This is different. Similar to insurance company, we're getting paid over and over and over again. And as long as an unexpected big disaster doesn't happen, we keep those premiums. But part of this strategy is we will be paying some premiums. So somebody says, oh, I have 99% success rate, or I've never taken a loss. I recommend you probably walk out the door or shut down that website, because it's just not realistic without sitting through monstrous pullbacks. That's just a fact. So I'm giving you building steps here, of course. So these are all just beautiful red and green candlesticks. Every single one of these are bullish setups. On the first slide, remember? So now I take this and I look at multiple time frames, I look at trends, support and resistance, and that gives us our high probability bias of what we think these patterns are going to do in the near term on the time frame we're trading. So I'm starting with a put spread. This green line, we're selling a put option under support. We're buying a further out of the money put option. The difference of those two numbers is the money that is immediately deposited into your brokerage account. That's the potential maximum gain that you can make in this strategy. And then we manage in between. We put a stop under support and over resistance for call spreads. And we can also do these naked. The benefit of a spread, though, is it's less buying power requirement at the brokerage firm, and it's less maximum loss if you have one of these big moves against you. So now we're going to take that strategy and talk about today's subject, which is a condor. It's a neutral time decay strategy. We're going to short an out of the money bear call credit spread over resistance and short an out of the money bull put credit spread under support. So we're collecting two premiums 2 premiums instead of just 1 premium on 1 spread. The maximum loss, because remember, you can only lose on one side if you hold it to expiration. And so that's actually another benefit of buying power. The broker only charges you buying power on one leg because they're obviously smart enough to know, well, you can only lose on one. So it's the spread with less the credit received. It's your maximum loss. And so here's just a little visual right here of a risk graph. So here's my max profit is the total premium received. My max loss is this. It's the upper strike plus my premium and the lower strike minus my premium. And I get this question all the time, and it is a very valid question. I don't want to dismiss it. People ask, well, why, in this particular example right here, why on earth would I take a trade, Dan, where my maximum gain is $100 and my maximum loss is $400? The reward to risk seems out of whack. Guess what? It is. I have 2 comments to that. Number 1, similar to the insurance company, why does an insurance company charge me $1,000 a year for car insurance when their potential maximum loss is over $300,000 on my policy? The answer is statistics, is probability. The probability of hitting a max loss, particularly when you use our technical-based approach, is we have never taken a maximum loss at Master Trader. That's a fact. No, it's never happened. Because we manage if it's going against us. So let's continue. So now, since we're chart-based, 90% of the time, I have a bias. I'm more bullish on this pattern or I'm more bearish on this pattern. Then I go through my credit spread checklist to determine if it's a green light to put the trade on or not. I'm now showing you the rest of the program here. I'm showing you our technical approach of the patterns and the management, etc., of selling an iron condor as an opening trade. This is the picture that I'm looking for. Again, not identical, but you'll see what I'm getting at here. I want wide trading range with multiple reference points of resistance and support, because that gives me the confidence that this is just going to bounce around in between my 2 short strikes. So I'm going to sell a bear call credit spread at or above resistance, taking some money for that. I'm going to simultaneously sell a put spread under support or below, taking money for that. I'm doing it in one transaction. So this is actually 4 separate individual orders, right? 1, 2, 3, 4. I have my total net credit that I'm trying to get. That's immediately deposited into my brokerage account, and that's my potential max profit. Here's just another picture. I'm not talking about the strategy yet, but notice, again, I got my wide support and resistance, right? So I'm going to sell and this is not a good example per se of the price, because there's not going to be a good strike here, but the pattern is perfect. I would sell an out of the money call spread, out of the money put spread. My checklist says, hey, make sure the options are liquid, make sure I get adequate premium, which I teach in the seminars, of course, and no pending news that you are not willing to take the risk of, which I'm going to show you here in a few minutes. We do sell these into earnings. We did one last night, made 60% of max gain overnight. Stop under support, over resistance, but again, there's different ways to manage them with adjusting rolling strategies, which I just unfortunately don't have enough time today. So here we go. Wide. Look at this. Wide. A gap down. I would have been bullish here. Big topping tail. Lower high. Little head and shoulders breakdown. It's right in the middle of the range. So I now go to my option table, which I kind of call the juice market. You know, I want to see what I'm going to get paid to put on this potential trade. So range bound income, you know, higher volatility, the better, because then we're going to get paid more for the options that we sell. But I don't have a formula. I don't, you know, so please don't email me and say, oh, damn, what's your minimum volatility? I'm going to say, I don't have one. Take the seminar and I'll teach you what an adequate premium is for the chart setup. So I'm going to sell the 260, 250, $10 wide put spread here. I have it circled here. There's my 260, 250. This is TOS. And now I'm going to sell a out of the money, 330, 340. So these are both $10 wide. As long as the stock stays in between these two short strikes at expiration, I keep all the money. I'm taking in a net credit of 90 cents a share. One contract represents 100 shares of the underlying. 10 is, you know, my default in my computer. I don't remember if I did 10 on this one or not. I don't remember. But if I did do 10, that would be $900 immediately is deposited into my account. It is mine to keep, provided I have legal obligations in return for that $900. There's no gifts on Wall Street. I have obligations. What are those obligations, Dan? It's to sell CMG at 330 a share on or before 22 days to expiration. That's obligation number one. Obligation number two, I have the obligation to buy 1,000 shares at 260 on or before 22 days to expiration. As long as you're willing to do either one of those, $900 is yours to keep. Now, we, as a general rule, I really don't want to own the underlying unless it's a multiple time frame setup where I say in advance, look, I don't mind owning, you know, I'm just using Microsoft's trading at 262 right now. If I sell a 220, you know, put spread, I don't mind owning Microsoft at 220 less premium received. If you divide the rate of return, the premium received by the brokerage is going to hold $9.10 a share. That's your potential maximum return on capital. The stops I talked about. Look at a couple of recent examples here. So this was AutoNation. We did this one last month. Wide range here. Okay, so let's see what we did here. We shorted way down here the 190 $10 put spread. The 130 is even off the screen here. You can't even see it. It's like $4 higher than this major resistance. We took in $1.55 a share in this particular example. Well, I didn't. I just loaded it up here to show you. So this is what it would look like. This is one contract I'm showing you here. That's the iron condor order that you'd send to your broker. Give me $1.55 a share per contract, or don't fill me. We were filled instantaneously. This is the format that we give all of our subscribers. We give the date, the symbol, the strategy. Are we buying, selling options, stock? What are we doing? That's what I'm doing. Every single one gives the technical setup. You're not seeing it here because this is a subsequent adjustment. So we entered this. Wow, so look at this. In one day, we entered this on July 25. We're closing this at $1.35. We're booking 35% of our max gain in one day, just to eliminate 25 days of risk. Because you know, if you can make 17% on your money in one day for pretty much doing nothing, then we did it. It's not normal, but in that example, we did it. Uber here. So I got a big, so remember I mentioned to you, a bonus is all three major moving averages. The blue is the 20, green 50, red 200. A bonus is all three of them relatively flat. Just think about that, common sense. That's telling me the short, medium, and long-term trends are sideways. Okay, Greg and I like to use the term McFly. McFly, that's, you know, I see it in the charts and I see it in the moving averages. So this is a great example. We sold the 30.27 down here. We sold the 35.38. This one had 10 days to expiration. 10 lot. Oh, this one shows 2 for some reason. A 10 lot, $540 hits your account. 54 divided by the maximum risk that your broker's going to hold. 22% maximum return on capital, and the stock can go against you as long as it stays between the $30 short put and the $35 short call. You make $540. Now, if I probably told you that in my introduction, hey, I'm gonna teach you a strategy where you can make 22% and the thing can go against you X percent, I would probably delete I would probably shut you down because it just doesn't seem rational. But it is rational if you understand what you're doing. Look, Greg and we do presentations. We have our every Wednesday on YouTube. We love educating people, and we're just going over charts here. And I can imagine some guys saying, "Oh yeah, Dan, you're just showing me good charts that are winners, like, you know, many other people, and, you know, walk the talk." Okay, come see us in the Master Trader Green Room. Pay $7, take a trial. You will interact with Greg and me for 5 trading days starting at 9 a.m. Eastern time, where we're walking the talk. We're putting on trades together in real time. A couple more examples here. You know, it's just going sideways. I mean, there's nothing to do from a swing trading basis on this thing, nothing. So I'm going to sell an out of the money put spread, out of the money call spread. Look at this example, 56 potential return on capital. Look, $1.80 is the credit on this one. That's crazy premium. And then you might say, oh yeah, but what if it breaks out or breaks down? Well, I told you before, we stop out either of the losing position or the whole position, or we use an adjustment strategy, a rolling strategy. This is a trade we're in right now, actually. We're in this now. So just notice this. It's a mess. Like, I mean, if you're a swing trader like we are, I mean, I sometimes in the green room, just as for exercises, I'll pull up a chart, anything, and I'll say, hey, I want everybody in the first 20 seconds to point out the most compelling trade opportunity. In this one, you know what? There's nothing really obvious. But in selling credit spreads and condors, that is a good thing. That's a good thing because it's a big sideways mess. So this one, we're in this. Look, page 1 of 2. So I obviously have something else to show you here. But this is a brand new trade format that we give in Telegram. So let's read it together. The date, which was just a week ago. Symbol, Duolingo. consider shorting the September one, because this one didn't have weeklies. I prefer selling shorter term options, 10 days or less, but guess what? Duolingo doesn't have them. So I either take the Septembers, which are more days, or I don't take the trade. That's what your trading plan is all about. So look at this big red line up here. Now I could teach little Johnny here, you know, after an hour of introduction. Hey, little Johnny, what do you think the odds of this stock, you know, busting a move above this red line are in X number of days? You'll say, that doesn't look like very likely to me, teacher. I mean, look at all the times it was rejected. Very good, Johnny. What do you think, Johnny, the odds of this going down below this pivot, this pivot, this pivot, this pivot, this one, and this one within the DTA? Doesn't look very likely to me, teacher. All right, Johnny. So here's what we're going to do. We're going to sell a call spread over 115, and in this example, we did $15 wide. And the reason we did that is because we want to keep as much of the net credit as possible. Again, in my seminars, again, I'm not hiding anything from you. I just have time limitations. But we get into all that of what dates, what strikes, what this and that. And so this one, you know, we did the put spread over here, $15 wide, 75.60. We sold it for $1.65 a share. I got filled immediately at $1.65, so that's why I told our subscribers, hey, try to get more. Try to get more than I did. So large sideways trading range, daily, weekly, far out of the money, short premium trade. Is that not exactly what we've just been talking about for 26 minutes? Is this? So now we put it on. As I said, we are in this trade. I took this screenshot this morning. 7 days later, we are at 55% of max profit. Well, what does that mean, Dan? Well, I told you the premium received is your max gain. So that's $1.65 a share. We closed half yesterday, 6 days, for 45% of max gain. And then this comes live to your phone and Telegram. You could be on the golf course, at work. I don't care what you do. I say close half here, 45% of max gain in 6 days, and bid 10 cents for the back half. Today's 8:31. The midpoint to close, so you could close this out right here at 75%. That is 55% of max profit in 7 days. So think again that you're an insurance company and you're selling a 1-year car insurance policy. What if you're the risk manager and said, wow, I can make 55% of my max profit by getting rid of this policy today instead of waiting till expiration? We teach that in the trade management section. So we actually closed the call spread for 15 cents. So that's to eliminate any upside risk. So if this gets something stupid, it gets bought out for $150, so what? So we've actually converted now the Condor just to a put spread. We closed the call spread at close to maximum profit. And I said, move the put spread to 84.88, which is still way, here's 85, still way the heck down here. Okay, so that's an open trade. Now, some of you also might be thinking, oh, well, see, I don't like people that only show me winning trades. Show me your losing ones, because that's where you separate, the bullshit from reality. Well, I agree with you, actually. I agree with you. I want to show you some losing trades, and here's one right here. But because of the strategy, so this one was into earnings, and I have personally sold options and spreads this earnings season, over 30 of them. And I think I'm profitable in 26 of them. And many of them went way against me. And the 4 losses I had were all very manageable. They were small. I took my loss and I moved on to the next trade. So this was one I was in. We did this into earnings because the volatilities are spiked into earnings and you get paid a lot more of the premium. So let's walk through it. We shorted the 16-14. So here's my big fat green line right here at 18, 17, 16. There you go, little Johnny. Then I'm selling the 24, 26. Okay, sounds good. I'm following. And let's see what I told subscribers. It's a range-bound income trade into earnings after the bell. So you have gap risk. Since it's only a $2 wide spread, remember I told you the max potential loss is spread with less premium received. So $2 less 51-cent premium received. I'm rich on one contract. I'm risking $149 to make 51. And again, you might say, well, that sounds stupid, Dan. Well, we're in a circular discussion that I told you about probabilities, because you're not going to get your max loss unless pins closes at expiration beyond one of these long strikes. All right, so again, this is page 1 of 2. Oh, look what happened here. That is a big gap against us the next day. So yes, I was in tight management mode. Of course I was. I mean, this could have been, taken out a 10-minute high and, I don't know, ripped up to 26 bucks. But if that were the case, then I would have pulled out my toolkit of adjustment strategies. I would have then said, okay, should I put on a new short put? Should I buy some stock to hedge? Should I stop out of this? And I have different tools to address to something directionally going against me. But with earnings, you have what's called volatility crush. The premiums that we're getting of selling options into earnings they're inflated because of the unknown risk. And I can't get into it now, of course, but option pricing is based upon supply and demand of those options, and that's what drives them to the level they are. So you have speculators, and it's also a function of the VIX, the market volatility index. Like when the market is on a multi-day or even preferable multi-week sell-off, like on Corona low, if we have any subscribers, or not subscribers, if we have any viewers right now who have been with Greg and me and Master Trader since the Corona lows and are option traders, it was like Christmas. We were selling so many crazy put spreads because with the volatility at record highs, the premiums that we were getting were off the chart crazy high. And so it doesn't need to be coronavirus low. We find these every single day, but my wheelhouse, well, I call it my wheelhouse, which means your comfort zone. I love selling put spreads on bullish reversals after multi-day sell-offs in the broader markets. So anyway, I gave you a long kind of answer to there of why these work. So we had a big gap against us, and you can see it pretty much immediately started falling in those expensive premiums that we sold into earnings. And there's no way to mathematically calculate what percentage they're going to drop on earnings. I mean, there is a way I can teach you. Can't do it now, of course, but I can look at the volatility of the current week and compare it to the following week. But you know, that's brain damage. I don't care. I know that this is the volatility crush. So these strategies into earnings work the vast majority of the time for this reason. Any gap against us, 90, you know, I got to go back and do some, you know, look at my trade records, but any gap against me, 96% of the time, the loss from the directional move is less than the gain from the volatility crush. So let's continue here now. So if I did a 10 lot, 510 bucks hit my account. As soon as it, you know, gapped up, I said, you know what? We actually got out of it at a penny. You know, just close the put spread for a penny or two, just like I did in that prior example, where I said, hey, let's kill the, you know, let's kill, you know, the to date where we killed the call side. It's just so I only have one side to manage now. So I got rid of my put spread at a gain. Now I got to manage my call side. On a pullback, intraday pullback, let's see what I did here. All right, we closed that one at 2 cents, good. Close the call spread at 17 cents. So even with this nasty gap against me, you can do the math yourself. We made 51 less 17, and it went that way, that much against me. I love the Roger here. He's been with us for a long time. He sent us this email with this image, and I just love it. And this is a popular claim we hear from our subscribers in selling options. They could be naked, spreads, condors. I made money and the stock went against me. Look, this is an absurd strategy, sarcastic tone. I mean, thanks for the compliment. Look, he loves, you know, Greg and me, we work great together. We've been trading and working together coming on 25 years here. And that's what's just at the time. Our weekly options trader for credit spreads, this particular streak we were in here, we're 54 for 56. Okay, just a few more concluding comments here. I've mentioned other ways to manage it, because when trades are working as intended, guess what? It's easy. It's easy. Little Johnny can do it. But when you get a gap in your face, like the pins or whatever it was, what's the Mike Tyson thing, right? When you get hit in the head, then you need to have some knowledge of what to do. So options allow us to tweak our positions. Since we are total technically based, and yeah, of course, I'm looking at volatility and some of the Greeks, but all of our strategies and adjustments depend on my bias. So even in the green room, somebody says, hey, you know, how about doing how about doing an iron butterfly on this? I'm like, well, tell me your bias. How about doing a combo? Tell me your bias. How about, you know, a bull diagonal? And then just like a doctor, you go to the doctor and the first question is, what's wrong with you? You don't just walk into the doctor and say, fix me. Well, I don't know what to fix. Tell me what's wrong with you. So tell me your bias, and then we can talk about the best way to handle and profit on your bias. So tweaking, you know, I can add, I can close, and I can adjust, bull or bear. It's trading options are three-dimensional. As long as the underlying pattern has not been negated. then I don't mind rolling to adjust my bias to receive additional credit. So whatever credit I started with, I would say, hey, let's do this. And we take in another 43 cents a share and raises our potential maximum gain. I teach both defensive and offensive rolling techniques, repair strategies, stocks, I call it one dimensional. There's nothing you could, how the heck are you going to repair a stock going against you other than doubling down and buying more to average cost basis? With options, there's so much more you can do. All right, we're just getting close to an end here, but you can see I'm so passionate to try to give you so much valuable information. And some of these things are just total sales jobs. And yeah, of course, I'm going to give you a great offer here in a second, but no, Greg and I, our main focus is to try to teach you some objective, systematic strategies that you can profit from now. So here's a starting checklist for you. Create a universe of liquid stocks and ETFs. ETFs is tougher. I love spiders, Qs, obviously. You got the AMDs, you got Facebook, Meta, NVIDIA. Build a list of 30 of them. Typically, it's like 125 or less that are really liquid, and that's because options have so many more expirations, you have so many more strikes. So even if you have the same number of market participants, they're spread out, and that creates wider spreads. Scan your universe. We use Telechart 2000. If you are a subscriber with us, taking a seminar or one of our letters, Greg will give you his scans that some people charge $5,000 for. Oh, I got a proprietary this and that. You will never hear Greg or me use the word proprietary. It's not in our DNA. I'm here to teach you. We will give you our scans. So in Condors, Greg created one called range bound. Isn't that what we just spent 40 minutes talking about, is range bound? And then you go through the list and you apply everything I've just taught you. Is it a good pattern? Is it liquid? Do I get good premium? Is there pending news? How many days to expiration? And then you put them on. So sell Iron Condor, I like about 20% of the credit spread. So if you're selling a $5 wide, because remember, you're collecting, just using round numbers, you're collecting 50 cents on the call spread and 50 cents on the put spread. 50 plus 50 is $1. Now, I don't have a slide on it, but we actually did a Condor yesterday on, I think, AMBA, A-M-B-A. We did a $5 wide and we took in $1.15, I think. Guess what? The stock capped $7 against us today, and we closed it out within a few minutes of the market open for 60% of the max, over 60% of the max credit, and the stock went $7 against us. We teach that. I love 30. Make sure it's liquid, no pending news. Follow your trading plans. Close half if it's a rapid 50%. You should get a lot more if you're playing the earnings volatility crush scenario. And come see us in the green room. You will watch us scan for trading opportunity in real time. Greg and I were presenting at some conference in Orlando. I literally watched Greg pull up his iPhone and he scanned in the elevator going from the 8th floor to the lobby, and he gave me 3 setups. We are never in doubt of finding compelling setups to trade stocks and options. Go to mastertrader.com/spread trader. Today we've been talking about selling options and credit spreads and Condors. That's these first 2. This is a great little 5 module, getting started. This one, 99% of the people are like, oh, I want more. This is an amazing, very detailed 12 module course, which includes a module on Iron Condors, of course. And I mentioned to you, when we have a compelling setup, we buy options, provided they're liquid, because of the benefits of limited risk, leverage, and if it goes against us and we stop out, we lose less money than trading the underlying stock or ETF. So I love trading options, both selling them and buying them. Now, at that link I just gave you, which is right here again, here's our little bonuses for you today. So the directional course, which is the third one on that prior page, 20% off. These are just additions. They're just, you add them on at checkout. So you can buy the Mastering Advanced Credit Spread course, get directional 20% off. This is a $287 value. It's the Kickstart options with Master Trader Strategies, free. Our weekly options trader, as I mentioned, its sole purpose is to sell options and spreads that expire in 10 days or less for weekly income using the Master Trader Strategy with the charts. My computer just clicked 2:15, so thank you very much for attending. Hope you learned a lot. You can email me, dan@mastertrader.com, with any questions, and good trading to everyone. Look forward to seeing you in the next presentation.
Hey, thank you so much, Dan. Thank you, Greg. You guys have really provided the trading community with incredibly valuable services and education. The technical bar-by-bar analysis you guys do at Master Trader, it's second to none. I love that iron condor strategy with these range-bound markets. Great stuff. Thank you so much for being here with us on Traders Corner. Ladies and gentlemen, that was Mr.